Last month, the S&P 500 dropped 4.8%, marking its worst performance since March 2020 when the COVID pandemic first impacted the stock market. Sadly, for investors hoping this volatility would be temporary, there seems to be new risks for the market every day. These risks include 1. Inflation. The rise in the prices of goods and services is the highest it has been in 13 years, and consumers now expect it to remain above 4%. 2. China. Over the past decade, Chinese companies have taken out a significant amount of debt, and now some of the largest real estate developers are close to going bankrupt. This is an issue because 15% of the nation's economy is tied to real estate development, and 70% of the wealth of China's urban population is in the housing market. More importantly, this could have ripple effects for the rest of the world, since China now accounts for 17% of the global economy. 3. Energy prices. The price of oil and gas is starting to rise rapidly as it becomes apparent that there are insufficient energy reserves as we enter the winter when demand rises. Typically, when prices rise rapidly, U.S. producers, which account for the largest share of gas production in the world, increase their output. Recently, however, American politicians and investors have encouraged them to refrain from adding fossil fuel capacity, instead pushing them to focus on becoming more green-friendly. As a result, these companies have been more focused on returning excess cash back to investors through dividends or stock buybacks, instead of investing in more production. Clearly, these new risks are adding more uncertainty to the stock market. Long-term investors don't need to worry, but short-term investors should ensure they have positioned their portfolio appropriately and then buckle up for a bumpier ride.